Welcome to the deep dive. We've gone through the latest intelligence briefing on the Bitcoin market, and we're here to give you that clear, informed picture. Today, the big theme isn't just, volatility, it's deeper. It's structural tension.
That's right. That tension is really driving what our sources are calling a market conflict.
Mm.
You've basically got these short-term pressures, think macroeconomic jitters,
Mm.
technical weakness, battling against, well, the long-term fundamental maturation of Bitcoin as an asset class.
So the market split, different players seeing totally different things.
Exactly. It means the market is completely bifurcated right now, strategic investors. They're acting on signals that tactical traders might be, well, completely ignoring or seeing differently.
Okay, so let's unpack that conflict. Our mission here is to first drill into those immediate pressures, the stuff pushing the price down right now, and then look at the strategic capital moves, the ones suggesting that deep-seated conviction is still there, almost ignoring the day-to-day noise. Let's kick things off with the immediate catalyst for all this market stress. It's pure geopolitics, isn't it?
It really is. President Trump has sort of reignited the whole U.S.-China trade thing.
Yeah, and escalated the rhetoric quite a bit, threatening tariffs up to 155% on Chinese goods starting November 1st.
And that threat alone forces a massive rethink of global risk, right?
Yeah.
Plus, the uncertainty is just amplified by this contradictory messaging.
You mean saying he wants a fair deal and a very good relationship with Xi?
Yeah, while also warning China they'd be in big trouble if a deal isn't reached. It's whiplash.
That kind of back and forth, that makes it almost impossible for businesses globally to price their supply chain risk accurately.
Exactly. And when you throw out a number like a 155% tariff, even as a threat, you trigger this sort of risk-off cascade. It hits everything.
Including Bitcoin.
Oh, yeah. Bitcoin's now pretty correlated to global liquidity, so it's sensitive to that kind of systemic shock. That shift is what's driving this immediate, quite painful volatility.
Okay, let's look at the charts then. The immediate impact. In the last 24 hours, Bitcoin broke down pretty decisively below $109,000, trading around $108,975 now.
Yeah, the market's definitely adopted a defensive posture. It tried to recover yesterday, but failed to hold.
And the technicals back this up.
They do. Short-term momentum is signaling, well, intense weakness. The RSI, the Relative Strength Index, it's dropped below 30.
Which is typically a sign of heavy selling pressure, right?
Yeah.
Strong sell signals flashing.
Correct. But, and this is key for an asset like Bitcoin, an RSI below 30 isn't just pessimism. It also signals an oversold condition.
So even though the fear and greed index is showing fear, it's at 40, we might actually be getting close to seller exhaustion.
Potentially, yeah. It could be setting the stage for a volatile reversal, maybe even a short squeeze if some good news hits.
So that's the tension playing out right on the chart.
It is. And for anyone trying to navigate this, that immediate support line to watch is the defense set up around roughly $107,600.
Holding that level is crucial then.
Paramount. If it fails to hold $107,600, the next likely target is the structural support zone down around $106,000. That's the real battleground for the next day or so.
Okay, let's zoom out a bit from the charts and the tariffs, because there's this really fascinating contradiction coming out of Washington, D.C., specifically from the Fed. Two major actions, seemingly pulling in opposite directions.
Yeah, it's quite something. First, you have a big deregulatory move. U.S. federal banking regulators, Fed included, just withdrew that 2023 framework for managing climate-related financial risks for the big banks.
And wasn't there some dissent on that?
Oh, yes. Governor Michael Barr called it purely political and said it defies logic. Strong words.
Okay, so that's one priority, seemingly getting pushed aside. What's a countersignal happening at the exact same time?
Well, on the very same day, the Federal Reserve is hosting this high-level payments innovation conference. And look who's attending. CEOs from Chainlink, Fireblocks, Paxos, Circle. You've got the CFO of Coinbase, the COO of BlackRock.
Wow, and the agenda?
Squarely focused on DeFi, stablecoin use cases, tokenization, the core of the digital asset space.
So why both things at once? What does this divergence actually mean?
It really signals a very clear internal shift in focus at the Fed, I think. It looks like they're shedding mandates they might see as maybe outside their core job, like climate risk, while doubling down on their fundamental role in payment system integrity.
And the fact that crypto and digital assets are now central to that discussion.
Exactly. It signals long-term integration. They're planning for this stuff to be part of mainstream finance at the highest levels.
And we're seeing echoes of this institutional shift at the state level, too.
We are. Look at Florida. House Bill 183 was just filed for the 2026 session. If that passes, it would allow state and pension funds like the big Florida Retirement Systems Trust Fund to put up to 10% of their funds into digital assets.
Directly or via ETPs, right? Exchange-traded products.
That's the key, yeah. Those ETPs are the vehicles.
Mm.
And a 10% allocation limit for a huge pension fund like Florida's, that's potentially a massive amount of institutional capital unlocked, money that just couldn't touch this asset class directly before.
Okay, let's switch gears to the money flow, the ETFs, because the headlines, honestly, they look pretty bearish. Fourth straight day of net outflows from the U.S. spot Bitcoin ETFs, totaling what, negative $40.5 million? Sounds like institutions are getting spooked.
It sounds like it, but you absolutely have to dig into where that capital moved. It's not quite so simple. If you drill down that entire $40.5 million net outflow, it came only from BlackRock's iBeat, the iShares Bitcoin Trust. It shed about $100.7 million.
Only IBIT, so other funds saw inflows.
Yes. That big withdrawal was actually partially offset by net inflows into 5 other major funds. We're talking Fidelity, Grayscale, Bitwise, VanEck, Invesco. They all saw money come in.
Ah, okay, so this isn't some mass exodus then. It looks more like maybe one big player exiting or rebalancing or rotating capital between funds.
Precisely. It suggests maybe a concentrated position exit or, like you said, capital rotation, not necessarily a broad loss of institutional conviction across the board.
Interesting. And how does this U.S. picture compare globally?
Well, if you contrast that sort of U.S. caution with what's happening elsewhere, the story changes again. Look at the U.K. The very first day, retail investors could access those physically backed Bitcoin and Ethereum ETPs on the London Stock Exchange. Demand was exceptionally strong. $10.6 million in volume. That's about 3 times higher than previous highs for similar product launches there. So global adoption seems to be marching on, kind of separate from these short-term U.S. macro fears.
And that underlying structural conviction, that long-term view, is probably most visible when we look at what corporations are doing strategically.
That's exactly right. The strategic capital, the corporate treasuries, they seem to be moving regardless of this daily noise. Take Hyperscale Data, listed on the NYSE. They now hold $60 million in Bitcoin on their balance sheet. That's about 66% of their entire market cap.
Wow. And they're open about their strategy.
Completely. They're pursuing a long-term dollar-cost averaging strategy, DCA, aiming for $100 million. They clearly see this volatility as an opportunity to accumulate more, not a reason to sell.
And this isn't just a U.S. thing, right? You mentioned Europe.
Correct. This whole idea of using Bitcoin as a reserve asset is moving into Europe, too. There's a German fintech, a Finio AG. They just announced plans to accumulate over 10,000 Bitcoin by 2027. Their goal is to become Germany's first pure-play Bitcoin treasury company.
Okay. And what else on the corporate front? M&A activity.
Yep, significant M&A too. Coinbase just bought Echo, a crypto investment platform, for $375 million. Specifically stated it's to expand their institutional product suite.
Investing in institutional growth.
Exactly.
Yeah.
And one more thing, On-Chain Intelligence picked up a big move. About $270 million worth of Bitcoin moved from a SpaceX corporate treasury. First time that's happened since July, apparently.
So these are big, deliberate moves, not retail panic.
Not at all. These are large-scale corporate strategic decisions happening right alongside this ETF market nervousness driven by macro fear.
It really seems like while the finance world is busy debating tariffs and, technical chart levels, the builders, the developers in this space, they're just heads down, ignoring the price swings and focusing on actually solving real problems, fixing friction points.
That's the real sign of maturation for any asset class, isn't it? The building continues regardless. Venture capital is still flowing in. We saw Printer raise $4.5 million, for example. Companies are building utility.
It's like what? Any examples?
Well, Nextech3D.ai launched this fraud-resistant programmable ticketing platform. It runs on Ethereum, integrates with Coinbase Wallet and MetaMask, real utility being baked in.
And payments integration is expanding too, making it easier to actually use this stuff in the real world.
Rapidly. Bybit Paid just partnered with Edrum, that's Armenia's biggest digital payments provider.
Right.
So now Bybit users can make QR code payments at over 25,000 shops and businesses across Armenia. That's bridging digital assets and everyday commerce at a significant scale.
That's pretty cool. What about technical improvements, making things easier for users?
Yeah, a key one is BitGet Wallet integrating EIP 7702. Now, this might sound technical, but it's important. This Ethereum improvement proposal basically lets users pay network transaction fees, gas, using stablecoins like USDT or USDC.
Ah, so you don't need to first buy ETH just to send some USDC.
Exactly. It removes a major onboarding hurdle, especially for new users. It just simplifies the whole process tremendously.
Okay, so let's try and synthesize all this. It's a really charged briefing. The market feels fundamentally split, bifurcated, as you said.
It really does. Short-term sentiment, it's weak. It's getting pushed around by these macro shocks like the renewed tariff threats.
Underneath that.
But underneath, the strategic capital, the corporate treasuries buying and holding, the M&A deals, the infrastructure builders, they seem to be absorbing the supply dips and just building the rails for the long term.
Right. So that gives us a pretty clear, tailored outlook, depending on who you are, yeah. For the tactical trader, someone playing the short game, a defensive stance seems favored right now, and that $107,600 support level is the absolute key thing to watch.
Definitely. If that breaks, the odds favor a deeper move down.
However, for the long-term investor, someone with a multi-year horizon, this current environment, this volatility, it actually provides a pretty strong case for accumulation, doesn't it?
It seems entirely consistent with the DCA strategies we're seeing from public companies like hyperscale data. They're buying into this weakness.
Okay, so key signals to monitor in the next, say, 24 to 48 hours.
Well, number one is that price defense at $107,600. See if it holds.
Right. And then the ETF flows, specifically IBIT.
Yeah, watch Tuesday's U.S. spot ETF flow data. See if that big IBIT outflow reverses or continues. That'll tell us something about institutional sentiment shift. And, of course, keep an ear out for any more definitive rhetoric on the U.S.-China trade front. That could move markets instantly.
Absolutely.
And maybe one final thought to leave you with. This combination of geopolitical uncertainty and increasing regulatory engagement, particularly from the Fed, it raises an interesting question. Given that the Fed is now actively hosting top crypto leaders, focusing on payments innovation, does this actually mean that the domestic political risk for digital assets here in the U.S. might be diminishing, even while global macro risk is spiking?
Less risk from DC policy, more risk from global events.
Something to think about anyway, as you keep an eye on those key technical levels we discussed.